Chapter Unit 3, Property and Casualty. Insurable interest. Insurable interest is often defined as the legitimate risk of financial loss in the person or things being insured. Obviously, the owner of the home has the insurable interest in the home. However, financial interest can exist for a party other than the owner. The mortgage company that has the mortgage on the home also has an insurable interest in the home. They could lose money in the house, burn down in a fire. Another example is a new car. A bank, an auto finance department has insurable interest and could lose money if the car is stolen. In property insurance, insurable interest may be present at the time of application, but must be present at the time of loss. If someone sells a home and later is damaged in a fire, that individual cannot claim the loss even if the policy remained in force because he forgot to cancel the policy when the home was sold. Measurable interest. Insurable interest, risk of financial loss, may be present at the time of application and must be present at the time of loss. Underwriting. Underwriting is the process of evaluating the risk of exposure of a potential client like this. During the underwriting process, the premium amount of coverage and amount of the applicant is determined. The agent is responsible for the field underwriting by the using of the pre-established criteria. They should seek out the types of risks that are likely to be acceptable and the company to deny those that aren't. Insurance companies employ underwriters who ultimately decide whether they accept or reject the application sent in by the producer or the agent and the bias of the company's underwriting standards. There are multiple sources of information used in the underwriting process to evaluate this risk. They include the client's application for the insurance, inspection services, the credit score and the Equifax of the TransUnion, government bureaus such as Bureau of Motor Vehicles, insurance industries bureaus such as the Automated Property Laws Underwriting System, financial information services such as Standard & Poor's, previous insurers, as the insurance company files the claim. Underwriting process of evaluating the risk, field and underwriting and performed by the agent or the producers. The company underwriting decides if the policy is to be issued. Application. The application is the primary source of the underwriting information. It contains information that will help the insurance company underwriter decide whether to accept the risk and if there is somehow so much premium that the insurer will be charged if the policy is insured, and the applicant must be completed accurately and submitted on a timely basis. Application, primary source of underwriting information. Binder. A binder is a temporary oral written statement made by the agent that gives the insured immediate coverage for the specified time. It is an oral statement. It is written and backed up and written as soon as possible. A binder does not guarantee that a policy will be issued. Underwriters decide. It's guaranteed temporary coverage under identical of the policy. Coverage under the binder will end at the later of the effective date of the policy if issued, the effective date of the formal cancellation notice if the company, insurance company, or when the cancellation notice is sent to the expiration date of the binder, 30, 60, or 90 days. Suppose John gets an oral statement for his insurance agent on July 6. He is bound in effect to the date for 90 days. On July 14th, John has a loss and will be covered under the policy. On July 21st, the insurance company reviews the application and decides not to issue the policy. Because of the agent's issue of the binder, John will have coverage for his loss. The binder, temporary insurance, usually given by the agents, verbal or written, can be canceled by the company. Does not guarantee a policy will be issued. Automatically ends if the policy is issued by the underwriter. The loss of expense and combined ratios, an insurance company evaluates those as income and expenses for given periods of time to measure this. The financial performance, they took a look and trends and may have incurred over extended period of time. The insurer uses the ratio to evaluate the performance of the bond. Loss ratio, expense ratio, combined ratio. The loss ratio is calculated by dividing the amount of incurred losses by the amount of earned premiums, and they compare the company's operation from year to year. It shows a percentage of the losses the company incurred for every dollar in earned premium. Loss ratio. Loss ratio equals loss incurred over earned premiums. Loss ratio compares companies' operations year over year. Earned premium is the premium the company actually earned by providing insurance protection to the designated period when the insurer pays the premium for months in advance. The insurer has to earn the premium each and every month to return the coverage provided. Incurred losses include the amount paid and the reserve on the claim and covered losses. The various expenses related to the handling of the claims expense ratio. This is calculated by dividing the underwriting expenses of the amount of the written premium. It is the indicator of the cost of doing business. Expense ratio. Expense ratio, underwriting expenses over the written premium. Expense ratio, cost of doing business. Underwriting expenses are the cost to acquire to keep the policy. That includes the expenses for advertising, commission, salaries, and administrative costs, and regulatory costs such as taxes and licensing fees. Written premium. Written premium. It is the gross amount of premium income received and insured. It includes both earned and unearned premiums. Premiums of new business, renewals, and policy endorsements make up the written premium. The combined ratio is simply the sum of the loss ratio and the expense ratio. Combined ratio, loss ratio plus expense ratio. Traditional 100% is the consideration to be break-even point. A combined ratio of less than 100% indicates that the company had an underwriting profit. A ratio greater than 100% indicates that the underwriter lost. Combined ratio. Loss ratio, expense ratio equals combined ratio. Combined ratio, 100% is break even. Greater than 100% is underwriting profit. Less than 100% is underwriter loss. Quick quiz. Which of the following is not a ratio that the insurer uses to evaluate performance? The cost ratio, combined ratio, expense ratio, loss ratio. The cost ratio. Cost ratio. Which of the following is a term in an oral or written statement made by the agent that gives the insurer immediate coverage for a specific time? That's a binder. That's a binder, baby. It's a binder. It said when the following is not an example of an insurable interest. Which of the following is not an example of insurable interest? A dog groomer's interest in the pets that are in his building for service. A person's interest in a home she owns. A person's interest in the home that his parents owns. A person's interest in the home improvement he has made to a rental property he owns. Interest in the pets that are in his building. It would be C. A person's interest in the home that his parents own. Which of the following is calculated by dividing the underwriting expenses by the written premium and is a good indicator of the cost of doing business? Loss ratio, cost ratio, combined ratio, expense ratio. Expense ratio. Expense ratio. Cost of doing business. Which is the primary source of underwriting information? The application, the binder, the insurer, the ratio, the expense ratio. What is the primary source of underwriting information? Really? the application, wouldn't it be? Is it not the application? The application is the primary source of the underwriting information. It contains information, the primary source of underwriting information, application. Alright, this is KING-KAMBUF, 100 proof, bringing you nothing but the truth. So help me God, amen, KAMBUF.